Hey, what's going on everyone? It's Griffin here, and a couple of weeks ago I released this video right here covering 5 dividend ETF options to supplement your portfolio with, well, some dividend income. But as many of you ended up pointing out, I didn't speak about any Canadian listed ETFs, right? So ETFs that trade on the Toronto Stock Exchange and of course in Canadian dollars. So that's exactly what we'll be speaking about in today's video. 5 great long-term Canadian dividend focused ETFs to create some portfolio income in, again, a period where appreciation is relatively scarce across the market. And the reason why some investors might actually even prefer investing with dividend ETFs because they can provide your portfolio with a consistent stream of income, diversification, minimize risk, and even represent a hedge against inflation. So in the same fashion as with the American dividend ETFs that we spoke about in that past video, well, today we're going to be looking for dividend ETFs that follow a relatively strict set of criteria, being the following. So first and foremost, we're looking for higher stability in returns over time, right? We're not looking for high levels of volatility here, and also considering the entire return, not just the dividend yield or just the appreciation over time. For a total return, we're looking at everything, both the dividend income as well as the return and market fluctuations over time for that security. Next thing we're looking for is a dividend yield that's above market, but not necessarily unrealistic, right? So we're not necessarily interested in a dividend yield that's 10-15% because most of the time this is not going to be sustainable over time for a variety of different reasons. And then finally, a low management expense ratio. We're not interested in paying 1.5% management expense ratio on these dividend ETFs. Let's get into it, and thanks a lot to Wealthsimple for sponsoring today's video, but more on how they can help you achieve your financial goals later on in the video. Alright, starting off with a popular option in the Canadian market, Vanguard Investments also happens to be a top ETF provider here in Canada, and one of their best dividend ETFs happens to be the FTSE Canadian High Dividend Yield Index ETF, ticker symbol VDY. Now, the reason why VDY is a solid dividend ETF option for long-term dividend investors is pretty much twofold. First and foremost, it has a passive indexing approach where it tracks Canadian-only companies of all sizes in terms of market capitalization, but that are characterized by a high dividend yield. And then the second reason is that it offers a pretty low management expense ratio with an MER of only 0.22%, which, comparing that to American positions is a little bit higher. However, when we're comparing this in the Canadian market, is among the lowest MERs. And by the way, if you're newer to ETF investing, well, an MER of 0.22% would mean that on a $1,000 investment, which is pretty much realistic for anyone watching this video, $1,000 into VDY at 0.22 MER would mean that you're paying $2.20 in management fees over the course of an entire year. So that is still very low. Now, due to the nature of the Canadian stock market, pretty much all equity Canadian focused dividend ETFs are going to have a high concentration of their positions in one of the following sectors. So primarily the financials as well as energy sectors, and also some other exposure to industrials, utilities, and communications. And that's exactly the case for VDY. So yeah, this fund actually only holds 47 individual stocks, of which 54% are in financials and 28% are in energy, as we can see from this chart, with other industries holding a much smaller percentage. With this in mind, most dividend ETFs that actually focus on Canadian dividend stocks rather than say a Canadian listed dividend ETF, but that holds American stocks or stocks from other countries, you need to be comfortable with a higher allocation towards those main sectors. So financials, energy, really utilities is also a larger sector in the Canadian market. That being said, the Canadian banking system is extremely solid and one of really the most stable banking systems really across the world. So that is something that you just need to be aware of if you're investing in Canadian dividend ETFs. As a result of this higher exposure and weighting towards the financial sector though, well, as opposed to say the S&P 500 that is highly weighted towards the IT sector, VDY has seen some depreciation over the past 6 months as well, down roughly 13% from all-time highs, but year to date the stock's been mainly flat, down around 4%. Now, since inception of the VDY ETF back in 2012, average annual returns for the fund have been 9.54% when taking into account both appreciation as well as dividend income, and really this is going to be one of the higher average annual returns, at least in the Canadian equity dividend ETF options, considering the relatively low management expense ratio at 0.22%. And finally, VDY offers investors a very nice dividend yield at 3.81% over the past 12 months, and that is on a monthly schedule. schedule. So if you're looking for that monthly dividend income, BDY could be a good option here. Keep in mind though that the actual distribution yields are going to be quite variable with an ETF because, well, there are multiple different companies held within the fund, and so this can fluctuate over time. But due to also the nature of the stocks in question that this fund invests in, I would give this one a risk rating of 3 out of 5 stars. Moving on to Canadian dividend ETF option number 2 here, we've got a fund that starts to dabble a tiny bit into positions outside of strictly the Canadian market, and that is the Invesco Canadian Dividend Index ETF, ticker symbol PDC. Now, unlike with the VDY ETF that we just looked over, PDC tracks a completely different underlying index, which happens to be the Nasdaq Select Canadian Dividend Index, meaning even though of the 44 stocks that this fund ends up holding, a lot of them are going to be overlapping VDY, while the weighting and allocations towards each one is going to be entirely different. That being said, the financials and energy sectors combined still end up making up roughly 70% of the fund, and then utilities and communications together make up around 26% of PDC. So yeah, this does definitely end up changing the weighting constitution of those top 10 holdings, but as with the goal of this fund in the first place, all of the holdings are still highly liquid, they have high yields, and also a track record of consistently growing those dividend distributions over time. Now, PDC does have a slightly higher management expense ratio at 0.54%, and actually this is starting to get on the higher end of the MERs in today's dividend ETFs, but it does have a higher yield to also make up for it. So this ETF currently has a very attractive dividend yield at 3.9% with monthly distributions as well, and returns over time are quite similar to VDY. Total returns, that is, we're looking at average annual performance of 9.2% over the past 10 years. Overall, you can't really go wrong with the PDC ETF if you're looking for a good dividend-focused exchange traded fund that has a nice yield as well as exposure to some of the key Canadian dividend players, and I would finally give this a 3 out of 5 star risk tolerance rating. Okay, moving into Canadian equity dividend ETF number 3 here, this fund actually holds the least amount of positions. It has the lowest management expense ratio of all the funds we'll be looking at today, and it also focuses on Canadian stocks only that have an above average yield and also a consistent track record of either steady or increasing dividends over time. This ETF is the iShares Core MSCI Canadian Quality Dividend Index ETF, ticker symbol XDIV or XDIV. This is the first ETF today offered by iShares, and they actually have a fantastic roster of dozens of great Canadian exchange traded funds to choose from, but the reason why this one in particular is great for dividend investors is because it has a very nice yield in combination with nice appreciation over time for a total return that is very attractive. And what makes XDIV different is that it only invests in securities that have strong overall financials, right? So solid balance sheets as well as less volatile earnings over time, which is really important to be able to maintain those dividend distributions, especially potentially entering into a recession here. Now, XDIV has a very high yield of 4.31%, which is really high for a dividend ETF because keep in mind the dividend yield of an ETF is derived from all of the different underlying companies together. And at 4.31%, this means just above $43 worth of dividend income on a $1,000 investment over the course of a year in this ETF, and that is after the super low management expense ratio of 0.11%. This is really the lowest MER that I was able to find, at least in the Canadian market, for a dividend-focused exchange-traded fund. So how is this higher dividend yield even possible, though, considering that it only holds 20 positions? Well, unlike the two other ETFs with XDIV, financials makes up 50%, but then energy is out of the main composition in place for utilities and communications, as we can see right here. And this is clearly reflected over into the top holdings, including Manulife, RBC, Fortis, as well as Sun Life. Finally, what about total returns and performance? Well, keep in mind XDIV has only been around since 2017, but nonetheless, it's managed to return investors average annual returns of 9.08% over the past 3 years. Closing off this section here, I would give XDIV a risk tolerance rating of 3 out of 5 stars as well. Pretty much all of these are looking like 3 out of 5 stars at this point. Speaking about earning dividend income through exchange traded funds, this integrates super well with today's video sponsor, Wealthsimple, Wealthsimple, who has a full suite of financial products and services made to help you achieve your financial and investment goals. Wealthsimple Trade is Canada's zero commission mobile stock brokerage that allows you to trade Canadian stocks and exchange traded funds completely commission free, which makes a huge difference on the value of your portfolio long term. All of the dividend ETFs that we're covering in today's video are actually available on Wealthsimple Trade, and what's awesome is that they're offering you 3 free stocks when you sign up and open an account with Wealthsimple Trade using the top link down below in the description. What I also love about Wealthsimple Trade is that they're always trying to be one step ahead of the curve by consistently releasing new features to the platform, like most recently fractional trading and USD accounts, giving investors even more flexibility. They've also fully integrated all of their other financial services like their stock and ETF trading with Wealthsimple Trade, the robo trading platform Wealthsimple Invest, as well as most recently Wealthsimple Crypto, all into one single platform, making it a lot easier for users to navigate their different accounts. So if you're ready to start investing in your own financial future, make sure to check out Wealthsimple Trade down below using the top link in the description, and you will get 3 free stocks, each valued up to $4,500 a piece, when you open and fund your account with a minimum of $150. And thanks again to Wealthsimple for sponsoring today's video. It's truly through opportunities like these that I'm able to continue making content for all of you to enjoy on my YouTube channel. So with that said, let's get back to the video. All right, back to the video with dividend ETF number 4 here. We've already covered Canadian focused ETFs that actually invest in Canadian dividend stocks, but what about if, of course, you're still Canadian, but you want exposure to the American stock market with US dividend stocks? This is where the BMO US Dividend ETF, ticker symbol ZDY, comes into play, offering Canadians a super easy way to gain exposure to American dividend positions while also highly benefiting from appreciation over time. Now, this ETF utilizes a rule-based methodology to select which equities it's actually going to hold within the fund, and this takes into account things such as the 3-year dividend growth rate, the dividend yield, as well as also the dividend payout ratio, so that, it's not just selecting a handful of high-yielding dividend positions. Speaking of dividend positions, this fund currently holds 101 individual stocks, with sector allocation mainly concentrated in healthcare, information technology, financials, as well as consumer staples. This, of course, is quite a bit different than in Canada, where utilities, financials, as well as energy were the main dividend sectors of choice, where this is actually one of the reasons, though, why this could be an attractive option for a Canadian dividend investor as well, to gain further diversity to other sectors also in another country. ZDY has a management expense ratio of 0.33%, so pretty much right in the middle there for management expense ratios on dividend ETFs, and it has a current dividend yield of 2.81%. So not necessarily the highest dividend yields of the options we'll be looking at today. However, this is also, keep in mind, in combination with higher average of appreciation than over in the Canadian market. So looking at total returns then, also taking into account appreciation here, even though this fund has only been around since 2013, average annual returns since inception in 2013 have been 12.41%. And finally, I'd give ZDY a risk tolerance rating of 2 out of 5 stars based on the dividend appreciation of the underlying holdings, as well as really just the nature of the holdings in question. And finally, for the equity only dividend ETFs, if you're still looking for exposure to the American dividend stocks, a great option would be the Vanguard US Dividend Appreciation ETF, ticker symbol VGG. Now, similar to the ZDY ETF that we just looked over, VGG also tracks the performance of a US equity index that measures the investment returns of common stock that have a track record of increasing dividend distributions over time. In the previous video I had made focusing on American dividend ETFs, I mentioned the VIG ETF, which is the Vanguard Dividend Appreciation ETF. So VGG is basically the same equivalent, where a lot of the companies are going to be basically overlapping and the same. This is really just the Canadian listed equivalent here. So with this in mind, VGG currently has 289 positions, most of which are going to be large cap or a mix of mid to large cap companies, with pretty equally weighted exposure to the industrials, healthcare, financials, tech, and also consumer discretionary sectors. The ETF has a pretty low management expense ratio as well, sitting at 0.30%, with a 12-month dividend yield at a lower rate of 1.45%. However, what makes this fund attractive is the combination of that dividend income with the appreciation you can expect, where total returns annualized over the past 10 years since 2013 have been 12.57%. So those were 5 Canadian listed dividend focused exchange traded funds. I really hope that you enjoyed today's video. If you found any value, make sure to comment down below what your thoughts were, but also don't forget to drop a like in the video and also subscribe, hit the bell button to be notified of new and upcoming stock market investing, dividend, as well as real estate and personal finance content. So I really hope you enjoyed the video. If you want to learn more, make sure to check out all the links down below in the description, where you can get some free money for signing up to different investment accounts, brokerage accounts, and also get access to my full stock market investing course completely for free on a 1-month free trial to Skillshare. So don't forget to check out all those links down below in the description. Thanks a lot for watching, and on that note, I will see you in the next one.